This video is on Chapter 10, Accounting for Long-Term Liabilities, and I will review the alternate exercises 10.8, 11, and 17. Exercise 10.8, alternate. We want to determine how to record issuing bonds and the related amortization of either a premium or discount, and in this case it is a premium. First, we'll look at the journal entry. This is a 7% 5-year bond sold on January 1st. Par value is 106. This is the amount they have to pay back, and they sold it for $114,231. because that is the carrying value on January 1st. So debit cash for $114,231. We have to pay back the 106. We'll credit that. The difference is the premium. They sold this bond for more than the par value. The premium is credited for the difference, which in this case is $8,231. Now we will look at the first and second interest payments. This is a 5-year bond. They pay interest twice a year, so there will be 10 identical journal entries related to paying the interest. They pay 7% a year. They're paying it twice a year, so they'll pay 3.5% every 6 months. The first interest payment is on June 30th. We will credit cash for the par value times 7% times 1/2, which is 3.5. Credit cash for $37.10. That's how much they'll pay out. We need to reduce this premium account. We initially credited the premium for the full amount of $82.31. This is a 5-year bond. We pay interest every 6 months. There will be 10 payments. We will take $82.31 and divide it by 10 interest payments, which means we will reduce the $82.31 by 1/10 every 6 months. So rounded, that comes to $823. And we will debit bond interest expense for the difference between the cash payment and the premium amortization. Every 6 months, we will have an identical journal entry to this. In exercise 10.11, we have sold bonds at a discount because the par value was $260,000, but we sold them for less than that, $251,600. This is a 20-year bond, and we have been paying interest at 8%. But now we want to retire these bonds so that we no longer have to pay the interest. After 6 years, they want to retire them on the open market and pay $273,650. Let's look at the bond discount at the time of issuance. So that would be the $260,000 minus the amount they sold them for, $251,600. The original discount total amount was $8,400. How much of that amortization has been recorded during this 6-year period? Original discount was $84,000. So the total amortization per year would be $8,400 divided by 20 years. So each year it would be $420. After 6 years, they have recorded a total of $2,520. So they've reduced the initial discount of $8,400 by $2,520. So now we can determine what the carrying value is. The original par value was $260. We have amortized $25.20 of the $8,400, so we have taken a total of $25.20, which means that we still have $58.80 left that we haven't amortized. This gives us the carrying value computed as the par value, $260,000 minus the unamortized discount of $58.80. The carrying value is $254,120, and they said they're going to pay $273,650. So now we can determine the gain or loss. The carrying value again is $254,120. They're going to pay $273,650, which is more than that. So they will have a loss of $19,530. But remember, the reason they're doing this is so that they no longer have to pay this 8% for the remaining portion of the bond. Now we can look at the journal entry. We are reducing bonds payable by $260 because we're taking it off our books. We just determined that we have a loss of $19,530, so that is debited. We need to remove the remaining discount of $58.80, and we're paying cash of $273,650. Again, make sure that your debits and credits are equal. Now we're looking at exercise 1017. This says they're issuing bonds with a par value of $570,000. The bonds mature in 9 years and pay 8% annual interest. On the issue date, the market rate is 10%, so they're only paying 8%. The market rate is greater, so these bonds will sell at a discount. We're first computing the semi-annual interest payment, so $570 times what they're going to pay. They'll pay half of that every 6 months. The semi-annual cash interest payment then comes to $22,800. This says how many semi-annual interest payments will be made. This is a 9-year bond, so there will be 18. Use the interest rates to determine whether the bonds are going to be sold at a par, a discount, or a premium. And we just said they're going to sell at a discount because the stated rate of 8% is less than the market rate. Now we're going to compute the selling price of the bond. We need to use present value tables in order to determine this. We will use two different tables. One is present value of 1, which is table B1, and the other is the present value of an annuity or ordinary annuity, which is table B3. You will have links to these tables in your homework. This is how you determine what row and number you will look at in the table. We're going to use 18 because this is a 9-year bond, which means we have 18 interest payments, and we use half of the market rate. The market rate is 10, so we're going to use half of that. So we're looking at in periods of 18 and the interest rate of 5. I'll show you where these values come from in just a minute. Right now we're going to take the par value and look up the amount of 18 and 5% in the B1 table. Then we're going to multiply that out by the par value to get the present value. Then for interest, we're looking at the table B3, the present value of an annuity. Again, we'll look at row 18 and column 5 for 5. Multiply that out, add it together, and this will give you the price that the bonds will sell at. The bonds have a par value of $570. but they're only going to get $503,358 in cash when they sell it. So there's our debit to cash, credit to bonds payable. The difference is a debit to the discount account. Now I'm going to show you the tables. So again, we're looking at row 18 and column for 5%. So 18 and then 5%. So 0.4155 from table B1, and then table B3, same thing. We're going to look at 18 and 5%. So we used 11.6896. So you can see those numbers here. These came from the table B1 and B3. Your last question is a Tableau assignment on recording bond issuances. This concludes the video for your Chapter 10 alternate exercises.